Now we want to test. Testing procedures, which is where the rubber hits the road. This is where most students struggle. And please note that this is section that you have to be extremely comfortable. Without you being comfortable on this part, it's almost impossible to pass audit paper. Your ability to design procedures is extremely important. So you cannot run away from it. You cannot avoid it. You have to learn it. And you don't have to memorize anything. You need to understand how it is done. And that's why I take a lot of time to explain to you. And you'll see, the approach I'm going to use for this as well is to make you comfortable so that you don't get stuck when you're asked to develop procedures, because a lot of students just struggle to come up with procedures. Now that's what we want to look at. And where I'm going to start this is to talk about assertions. Without assertions, without good knowledge of assertions, you can't have a good understanding of audit testing, because it's like playing soccer match without a goalpost. How do you know the winner? How do you know the scores? How do you know that you have achieved an objective? That is the essence of assertions. Your assertions are your audit objective. These are your testing objective. This is the comfort that you are looking for. In fact, that is the assurance that you are looking for. So, you need to know what are the relevant assertions for the balance you want to test. When you know the assertions that are relevant for those balances, then it is easy to design procedure for those assertions. So, what are those assertions that we're talking about? I will divide them into two groups. And that is talking about the assertions that are relevant for profit or loss account balances. Remember, what you are auditing will either be in profit or loss or is in the statement of financial position. So if you're talking of profit and loss balance, you are talking about occurrence. That's number one assertion you are learning now. Occurrence. Similarly, in SFP, we don't call it occurrence, but we call it existence. I will explain each of these assertions to you, so let me just list them first. The same way we have accuracy in profit or loss balance, we have accuracy, however, we add valuation to it in statement of financial position. So it's accuracy and valuation. Completeness is another assertion which is common to both P&L and statement of financial position. That's another assertion, completeness. We also have presentation, that is common to both of them, presentation and disclosure. We also have presentation and disclosure. We have cutoff. We don't have cutoff for statement of financial position, but we have something we call right or. Please not and, because you cannot have both right and obligation on one balance. It's either you have a right on an asset or you have an obligation on a liability. Remember, obligation is for liability, right is for asset. So these are the major assertions that we are looking at. So you have 5 assertions at the minimum to address for each balance. So every time you are asked to audit a balance, take for instance, they are asked to come up with audit procedure for revenue. First question you ask yourself, please, is revenue a statement of financial position item or profit or loss? Yes, it's a profit or loss item. So what are the relevant assertions? These are them: occurrence, accuracy, completeness, presentation, and cutoff. Those are your assertions. The next stage for you now is to develop procedures for each assertion, because you need to have confidence that there's a transaction, amount is accurate, everything has been recorded, it has been shown on the financial statement correctly, and no items outside the year under review has been included. Yeah, and that's what I'm going to explain for each assertion. So you need procedure for each assertion before you can conclude that revenue has been audited and there is no misstatement or there is a misstatement. Now let's look at the meaning of each assertion. Occurrence. When you are talking of occurrence, let me take the first one, occurrence. What we are just saying in occurrence is that there was a transaction, that the transaction truly occurred. That is what we are saying. Take for instance, let's look at revenue to explain this. For occurrence, you're asking, was there a transaction? That is the meaning of occurrence. The transaction occurred that truly generated that revenue. And if you ask yourself that question, it's easier for you to think about what sort of document should you be asking for that will show that there was a revenue. And in that case, you will know that you need to be looking for a dispatch note, because when you sold, you must have sent a dispatch note to your customer. Likewise, even invoice can give you such confidence as well. So you're beginning to say, transaction, if I can find a dispatch note or I can find an invoice, definitely there was a transaction. Then you know that by the time we start solving questions now, you will see that these are the assertions that will drive us, that will give us that inspiration on what should we be asking for. The next one is accuracy. And what is accuracy talking about? Accuracy is just looking at whether the figure is correct. Remember, occurrence is whether the transaction truly occurred. Now, accuracy is looking at whether the amount is correct. Financial statement has said 20 million. Is it really 20 million? Should it be 25? Should it be 18? And you know that, likewise, you will need to be asking for invoice to confirm that amount, because the customer would have acknowledged the invoice that, yes, we received this invoice and we will pay. Completeness is the third assertion. And what is this talking about? This is just asking you whether all transactions that are meant to be in the financial statement have been recorded. So that is what completeness is all about. It's checking that there is no omission. Simple. No omission. Record all transactions. That is what we'll be checking. And how do we test this one? Let me give you a clue to this, because this can be tricky. Anytime you want to check for completeness, please, you always move from source document. And I will explain to the GL. GL is your financial statement. GL is where you have the figures on the financials. Remember, when we're talking about accuracy, we must have selected this 20 million from the financial statement. Then we're asking for the invoice. So which means we're coming from the GL to the source document. However, when we want to talk about completeness, we'll go from the source document to the GL. So this is accuracy, but this is completeness. So if I say, I just pick randomly some invoices from the invoice file and I say, I want to see where you recorded these transactions during the year. That is completeness testing. But if I go into the GL and I pick a figure and I'm asking, show me a document, that is accuracy. That is occurrence. Okay? So please take note. From source documents to GL is completeness. Another way to put it is from floor What's another word we use for it in audit? Floor to GL or floor to sheet. Because the paper is the GL, but floor is the real thing. Take for instance, if I want to know whether all assets have been recorded, I can go and just pick any equipment on the warehouse and say, this equipment I've picked, show me where you have it in your asset register. Show me where you have it in your GL. It's completeness, because I'm going from outside of the GL to the GL. Please take notes, because I know students confuse a lot about that. And we'll get there when we start solving questions, but I need you to have a good understanding first before we go into real question. Okay? Another way is completeness of liability. So I've talked about completeness of transactions, talked about completeness of assets. Now, this is for transaction, this is for assets, because remember, this is common to both of them. So that's why I'm going to explain them together now. So if it's for liability and you want to test for completeness, it's still similar to what we're talking about, but in a different way. Usually, remember, you have a liability as at year end. Balance sheet date, reporting date. So let's say 31st of December 2024. You're going to have a liability balance, and you want to check whether this liability is complete. The way you test it is you go post year end. Say January. You collect January bank statement. And what are you looking for? You are looking for payment that they made. So if they made a lot of payment, you can select some samples of payment and say, this payment that you made in January, just after the year end, because as an auditor, you know that there's a possibility that they have been owing that money before, because it's very impossible that a business is owing money and is paying immediately. Yeah, that hardly happens. There are usually 30 days, payment days. So you ask them, this payment you made in January, when did you perform the transaction? They will tell you. If they say it's December, it's November last year, then you're asking them, show me how you have accrued for it as a liability in your financial statement. That is another floor to sheet. So you are going from this bank statement, you're going from bank statement to the GL. You can see it's always to the GL, not from the GL. That is completeness for you. Okay? The next assertion is presentation. This one is easy. Presentation, what you're just asking is that, have they put the item in the right place in the financial statement? Has asset been put into the asset place? Is current asset been put in the current asset place? Is non-current asset been put in non-current asset place? Is income in income side? Is revenue in revenue? Is expenses in expenses? So it's about where exactly the item is meant to be put and it's been put. You cannot net off account receivable and account payable. You put account receivable and account receivable, put account payable and account payable. Not merging income and expense. You put income as income and expense as expense. That is all what presentation is talking about. And the last one for the income statement or profit or loss account is the cutoff assertions, which is another we need to please pay attention to. And what is cutoff talking about? Cutoff is saying you have to record transactions in the period they occur. Record transactions in the period they occur. So if transactions occurred in 2024, please, you have to record in 2024. If it occurred in 2025, you have to record it in 2025. You don't record 2025 transactions in 2024, or you're recording 2024 transactions in 2025. That is prohibited, and that is what you need to check for as an auditor so that you can have comfort on cutoff. Very important. And usually how do you do? Because I know sometimes people confuse this with completeness. It's slightly different. Yeah, I agree with you that it touches on completeness kind of, but it's slightly different because this one, remember, completeness is all transactions in 2024 has been recorded. But when you are talking of cutoff, you're also checking that 2025 transactions has been excluded. So if you don't do cutoff, you can have completeness satisfied, but if it is over complete, which means you have 2025 even being added to 2024, then cutoff has failed. So if you are looking at 2024 and your December is your cutoff date, 31st of December, then only these transactions are allowed. But if you have transactions in 2025, they should stay in 2025. In completeness, what you'll be checking is that all 2024 transactions has been there. But you can have more than that, which means 2025 has been included, and in that case, completeness will say it is fine. However, cutoff means it is failed because you should not have 2025 transactions in 2024. So that is the difference. Please take note. Let me give you an example, still on revenue, how it can happen. We say revenue, we will know that we have sold when goods dispatch notes has been sent. That this is a document that we'll be looking for, right? So which means you as auditor, you need to check this good dispatch notes for 2024, samples of 2024. Make sure they record it in 2024, and you take samples for 2025, and you make sure that they record in 2025 and not 2024. Okay? And with that, you will know that you have done the work you have to do on cutoff. Now, those are the assertions for PLL. What about similar financial position? Existence is similar to occurrence, but the difference is that because it's about asset and liability. Yeah, you don't say asset has occurred or liability has occurred. You say asset exists or liability exists. So it's similar to occurrence, but it's different because we talk about whether the company truly have the asset or they truly have the liability, and it is called completeness and not occurrence. Accuracy is the same thing as you have in PRL, and valuation is talking about the amount as well, recoverability of the asset. Because remember, in your conceptual framework, the definition of your asset is that resource is a resource controlled by an entity through which economic benefit should flow in the future. So your question is that the amount that has been assigned to that asset, does it equate to the same economic benefit you are expecting from that asset? That is about valuation. Completeness, I've dealt with that. Presentation, I've dealt with that. Right and obligation is about also for asset, like I said, and obligation is for liability. So what you are checking here is that does entity truly own the asset? Do they really control the asset? Or do they really have a liability? Do they have an obligation to pay anybody? That is what all those assertions are looking for. And that is what we'll be looking at when we start dealing with each of those balances, which are required to know under this syllabus. And the focus will be on PPE. We'll look at PPE. I'm going to make videos on all of them before we start solving questions. Inventories, you are required to be able to develop procedures on account receivable. Likewise, account payable, must be able to develop procedures. Cash, share capital, directors' emoluments, very important. Intangible asset, provisions, and contingent liability. So all of this, you need to be able to develop audit procedures. And you will see what you will be focusing more is on assertions, because if you know the relevant assertions, likewise for P&L, you're looking at revenue and purchases, because they are also linked to your account payables and your account receivable. Right. So once you know the item, is it P&L, is it statement of financial position item, then you come up with the assertions. Then when you know the assertions, you can develop the procedures. Now it's time to develop procedures.